Stop obsessing over your win rate. It is literally a useless number on its own. You measure your entire self-worth by how often you see a green number on your screen. You take a trade, the line goes up, your brain floods with dopamine, and for a brief, shining moment, you feel like a financial genius who has finally cracked the code of the universe. You win 5 trades in a row. You start doing mental math, multiplying today's profits by 250 trading days, convinced you will be casually shopping for private islands by next summer. Then Thursday arrives. You take a trade. It goes slightly against you. You refuse to close it because your win rate is your pride, and taking a loss means admitting you were wrong. You hold it. It drops further. You move your stop loss because you are suddenly seized by the absolute certainty that it will turn around any second now. It does not. By the time you finally close the trade, your hands are shaking, your throat is dry, and you have just wiped out 3 weeks of profits in 45 minutes. You had an 80% win rate, your account is bleeding out, and you are not stupid for doing this. You are a completely rational person acting inside a heavily rigged, culturally overwhelming system. You were sold a very specific dream by a 22-year-old on the internet standing next to a rented sports car. They told you that good traders never lose. They told you that if you just draw the right colorful shapes on a chart, you can predict the future movements of multi-billion-dollar banking institutions. They handed you a rigged compass. You followed it into a swamp. Wall Street algorithms do not have egos. They do not care about being right. They do not feel a warm glow in their chest when they hit a winning streak. They only care about one cold, hard mathematical equation: expectancy. Once you understand how to balance the seesaw of win rate and your risk-to-reward ratio, the game changes entirely. The panic stops. Losing streaks will no longer scare you. You will finally stop trying to be a psychic, and you will start acting like a casino. This is the hidden math behind profitable trading. The first thing you have to accept is the inverse relationship rule. Beginners believe the ultimate goal of trading is finding a magic strategy that gives them an 80% win rate and a 1-to-4 risk-to-reward ratio. They want to be right almost all the time, and when they are right, they want to make 4 times what they risked. Mathematically, over a large sample size, this is a complete fantasy. You cannot force the market to give you both. Win rate and risk to reward operate on a strict seesaw. As one goes up, the other is forced down. By nature, strategies with a massive payout, like trend following, have terrible win rates. You might only win 30% of the time. Strategies that win 80% of the time, like scalping, usually require you to risk exactly as much as you make, or sometimes even risk more than you make. The math refuses to bend. You cannot cheat the seesaw. When you try to force a high win rate out of a strategy designed for big payouts, you just end up making a very confident mistake over and over again. You have to accept this inverse relationship to stop jumping from strategy to strategy every time you hit a losing streak. Your profitability is determined by one equation, and it is the only boss you answer to. It is called expectancy. The formula is simple. You multiply your winning percentage by your average winning dollar amount. Then you multiply your losing percentage by your average losing dollar amount. You subtract the losers from the winners. If the number is positive, you have a license to print money over time. If the number is negative, you are slowly burning your money, while paying broker fees for the privilege. Amateurs focus entirely on their win rate because their ego cannot handle being wrong. Intermediate traders focus entirely on catching massive home run trades because they lack patience. Professional traders focus strictly on expectancy. You can be wrong 60% of the time. You can spend more than half of your working week being completely incorrect, losing trade after trade, looking like an absolute fool to anyone watching over your shoulder. You will still be wildly profitable. Expectancy is the only metric that decides if your account breathes or dies. But here is where the math gets heavily distorted by human panic. There is a massive canyon between your planned risk to reward and your realized risk to reward. You sit down on Sunday night. You write out a beautiful, disciplined trading plan. You swear to the heavens that you will only take trades that offer a 1-to-3 ratio. You will risk $100 to make $300. The spreadsheet says if you do this with a 40% win rate, you will be rich. The spreadsheet is flawless. Then Tuesday morning happens. You enter a trade. It goes into profit by $100. The market suddenly pauses. A red candle flashes on the screen. Your chest tightens. You remember the money you lost last week. The fear creeps in, whispering that the market is going to reverse, and take your $100 away. So you panic. You smash the close button to secure your tiny profit, letting out a deep sigh of relief. You survived. Your trading plan said 1 to 3. Your shaking finger just turned it into a 1 to 1. When you look at your actual closed trades at the end of the month, your realized ratio is nowhere near your planned ratio. The spreadsheet said you were a genius. Your actual bank account violently disagrees. You must calculate your mathematical edge based on the brutal reality of your closed trades, not the fantasy of your trading plan. This exact same fear leads to a trap that most traders think is highly professional advice. The internet tells you to scale out of your positions. They say you should always pay yourself. If you are halfway to your target, you are told to sell half of your position to secure profits and let the rest run. It sounds incredibly responsible. It secretly destroys your mathematical edge. Taking partial profits completely alters the expectancy of your trading system without you even realizing it. Imagine you risk $100 to make $200. That is a 1 to 2 ratio. You need a specific win rate for that to be profitable. But halfway there, at $100 in profit, you get nervous. You sell half your position. Your realized ratio is no longer 1 to 2, it just dropped to 1 to 1.5. If your win rate was only profitable because you desperately needed that full 1 to 2 payout, scaling out just turned a winning system into a losing one. You thought you were being safe. You were actually sabotaging the only math that was keeping you afloat. Never scale out unless you have back-tested your strategy and proven mathematically that your win rate is high enough to survive the reduced payout. Safety is an illusion. Math is reality. Which brings us to the ultimate psychological comfort food, the break-even stop-loss. There is no feeling in the world quite like moving your stop-loss to your exact entry price. The trade is suddenly free. You have zero risk. You can step away from the monitor, make a cup of coffee, and relax. You tell yourself you are protecting your capital, moving that little red line up so you can finally take a breath and stop staring at the screen like a terrified animal. You are just ensuring failure. Moving your stop to break even too early is a death sentence for your win rate. The market does not move in a straight line. It breathes. It pushes forward. It pulls back. It tests levels, and then it continues. When you move your stop to break even the second you see profit, you are placing your exit directly in the path of a normal market pullback. You will get stopped out for $0. You will feel a brief sense of relief that you did not lose money. Then you will watch in absolute agony as the market turns around and runs perfectly to your original target without you. You were perfectly right about the direction. You made $0. Do this enough times, and your mathematically profitable strategy bleeds to death from 1,000 tiny cuts. Never trail your stop loss to break even until the market has actually broken a new structural level to validate the move. Accept the risk you took when you clicked the button. All of this math eventually crashes into a wall. That wall is your brain. On paper, a 1 to 5 risk to reward strategy with a 25% win rate is incredibly profitable. It looks like a money printer. You lose small, you win huge. The math is undeniable. In reality, a 25% win rate mathematically guarantees that at some point this year, you will face a streak of 12 to 15 losses in a row. You will wake up on Monday, lose twice, and go to sleep. Tuesday, you lose 3 times. Wednesday, 2 more losses. By Friday, you have lost 10 times in a row. You have done absolutely nothing wrong. You followed your rules perfectly. But your psychological capital is completely drained. Your confidence is shattered. Your heart rate is that of a hummingbird on espresso every time you open the charts. Monday comes around again. Trade number 13 sets up perfectly. It meets all your rules. But you cannot do it. You stare at the button, paralyzed by the memory of the last 10 losses. You skip the trade. Naturally, trade number 13 is the massive 1 to 5 winner that would have made back every single dollar you lost last week, plus a heavy profit. You missed it because you ran out of mental capital before you ran out of financial capital. You do not just trade what makes mathematical sense on a piece of paper. You must trade the specific ratio that your mental fortitude can actually execute without hesitating. If you cannot handle losing 10 times in a row without having a mental breakdown, you cannot trade a low win rate strategy, no matter how profitable the math claims to be. This exposes the greatest lie sold to beginners, the 90% win rate death trap. You see people boasting online that they almost never lose. They sell courses based on this claim. They prey on your natural human desire for certainty. You think if you just follow their system, your account will grow in a perfectly straight line upward. and you will never have to feel the sting of a red day again. A 90% win rate usually masks a deeply toxic inverse ratio. To win that often, these traders are usually risking $500 just to make $50. It works beautifully for a few months. They look like absolute market wizards. They scoop up tiny profits day after day. Their ego inflates. Then a completely random event happens. A news story breaks. A central bank makes an unexpected comment. The market aggressively spikes against them. Because their entire identity is built on never losing, they freeze. They refuse to close the trade. They move their stop loss wider and wider, praying for a reversal. In a single afternoon, one bad trade wipes out 40 consecutive wins. The illusion shatters. High win rates are often just a psychological crutch for people who are entirely incapable of accepting that they are wrong. There is a better way. It is just remarkably boring. Imagine two traders. Strategy A gives a simple 1-to-1 risk-to-reward ratio with a 55% win rate. It sounds completely unsexy. It is a coin flip with a tiny, slight edge. Strategy B offers a massive 1-to-5 payout, but only wins 30% of the time. It is the strategy of internet legends. Strategy A will usually build wealth exponentially faster. The hidden variable nobody talks about is trade velocity. It is frequency. If the boring 1-to-1 setup occurs 5 times a day, your tiny edge is multiplying rapidly. It compounds. If the sexy 1-to-5 setup only triggers twice a month, your money is sitting idle, doing absolutely nothing for weeks at a time. Frequency multiplied by a small, consistent edge beats waiting around in the dark for a rare home run. You do not need to capture massive market swings. You just need a tiny statistical advantage that repeats itself over and over again. When you look at the raw data of the most consistently profitable prop firm traders in the world, the reality is shocking. They are not hitting massive 10-to-1 sniper entries. They are not winning 90% of the time. The vast majority of quiet, professional traders hover right around a 45 to 55% win rate. Their realized risk-to-reward ratio sits between 1 to 1.5 and 1 to 2. This is the magic psychological sweet spot. You win just enough that you do not fall into a deep depression. You lose just enough to keep your ego in check and remind you that you do not control the universe. Your winners are just big enough to effortlessly absorb your losers without requiring you to hold a trade for 3 terrifying days. It is a perfectly balanced seesaw. The market is not a puzzle you solve by being right all the time. It is a casino where you are the house, managing the math over thousands of small interactions. You are going to take losses. You are going to be completely wrong about the direction of a currency or a stock. The market will embarrass you. Let it. Your job is not to predict the future. Your job is to make sure that when you are inevitably wrong, it costs you a fraction of what you make when you are right. Stop staring at your win rate like it defines your intelligence. Stop moving your stop loss to protect your feelings. Accept the math, embrace the losses, and let the expectancy formula do the heavy lifting. You do not have to be perfect. You just have to be profitable.